Good morning, everyone. Welcome to our weekly research morning call. Today, we have a few stock counter updates, including the initiation on Apple Inc., Singapore Banking Monthly, before wrapping up with our usual Singapore Weekly. So without further ado, let me begin with a flip on the ground on OTS Holdings second half 21 results. Thank you. OTS is a major ready-to-eat and ready-to-cook meat product manufacturer. They have a portfolio of brands, but mainly there is the Golden Bridge brand, under which they have a variety of luncheon meats and also products under other segments, under other brands, including sausages, as you can see from the pictures. In the results summary table for second half 21, the revenue was down mainly due to the impact from the movement restrictions.
There is no, it's still on the first page. Oh, okay. Now it's okay. All right, continue.
Yeah, thanks, Paul. Yep. So anyway, to continue, the revenue for second half 21 was down mainly due to the movement restrictions in Malaysia and Singapore. If we look at the individual segments, you can see that the revenue was down for almost all the segments except for general trade, which included the sales from convenience stores, provision shops, and wholesalers. This segment also recorded the highest growth on a full year basis of 34% increase. For general trade, this was less affected by the movement restrictions if you compare to the other segments like modern trade, which includes sales from major supermarkets, and also food services, which includes sales from the restaurants, hawker centers, food courts, and these were disrupted by the dine-in restrictions. So if you refer to the bullet points on your top right, you can see that on a full year basis, the increase in revenue of 11% was mainly due to higher sales from general trade as mentioned. And for the geographical segmentation, the revenue from Malaysia increased 63%. And because for first half of FY21, it was 7.5 million. So you could see the impact from the movement restrictions for second half of FY21. And on the other hand, revenue from Singapore declined by about 4%. So moving on to the outlook, OTS Holdings is continuing their expansion plans in Malaysia, which has also borne fruit, as you can see from the revenue increase from Malaysia. And also for the contribution-wise, it increased from 22% in FY20 to 32% in FY21. Apart from movement restrictions, we are also expecting increased competition from the major Korean competitor lowering their prices. And if we compare between Singapore and China brands, actually for Malaysian consumers, they are more inclined to purchase Singapore brands, which are more known for food safety. So there's this level of trust. Apart from that, OTS is also entering the Philippines market. And considering that this is a totally new market for them, we would expect them to need to spend more to build the brand in the initial stages. They are also expanding distribution to distributing non-house brand products. And this is leveraging the established distribution network that they already have. Lastly, there's the introduction of plant-based food products, including plant-based canned luncheon meat, which they intend to launch by early 2022. We think that this could be a breakthrough product given the novelty. So comparing to other plant-based food products that are already available, this is different in the sense that it is ready to eat compared to the raw ones that are already available to the market. And also it could be kept for longer periods of time, for maybe a few years. So this could probably be the biggest share price catalyst after the launch planned for next year. So that's all for OTS Holdings. I'll now be moving on to a brief summary on the POEMS webinar that we had with Koda last week. Next slide, please. Okay, firstly, in terms of its manufacturing business, the order book remains robust with no signs of slowing down. However, with the production disruptions caused by COVID-19 restrictions, the lead times have extended from 3 to around 6 months now. So if you order now from the manufacturer, you can only receive your order in March next year. But since this is across the industry, then the customers would just have to order earlier and wait for their products. Other than that, the production capacity expansion is on track with the acquisition of land use right and factory building in Vietnam. According to the figures published on the land use areas, we are expecting an increase in capacity of around 20 to 30%. They are also entering into manufacturing so fast, but something different between...
So it's okay, it's okay. The slides are very slow, so just make sure that when you're talking, the slides are there. Yeah, okay, continue.
On my side, it shows Koda slides. Yeah. But anyway, so they are specializing in make to order, something different between them and other much larger sofa manufacturers. So they are specializing in the more premium kind of products. They are also working to resume operations in Malaysia and Vietnam. And as shared last week, this would mean ramping up the vaccination rates among their employees before they can resume work. Finally, for Commune, which is their retail and distribution arm, they are continuously working on the expansion plans in China. And the especially exciting one would be the opening of the flagship store in Shanghai, which would be similar to the one at Millennium Walk in Singapore in terms of the product offerings and also the shopping experience that you can get from the store. So that's all for me. I'll now be passing the time on to Terence for Koufu.
Yeah, thanks, Vivian. We published a report on Koufu's first half 21 results. So Koufu reported first half 21 results with revenue and net profit in line with our estimates, about 50% of our full year 21 estimates. So some of the positives for Koufu is that despite the Singapore going into phase 2 heightened alert from 16 May to 13 June, they saw increased takeaway and delivery sales, which mitigated the lower footfall during Singapore's phase 2 heightened alert. So first half 21 net profit, when we compare it on a half-on-half basis, actually grew 35% on a half-on-half basis. So if you look at the table on your left-hand side, you can see that the revenue and EBITDA and PATMI and free cash flow actually increased, all increase across the board on a year-on-year basis as Singapore starts to reopen and lighten the safe distancing measures. In terms of the positives also, the footfalls also improved in Macau with the outlook positive. Borders reopened in March this year, even though footfall was still about 39% lower than pre-COVID levels. Another positive is that TOP was obtained for their integrated facility, and Koufu expects to progressively commence operations from the third quarter of 2021. In our next slide, in terms of the negatives from their results, even though they relaxed footfall and allow for more dining measures, footfalls were still about 65% of pre-COVID levels. This is because of the safety management measures still in place, workers still working from home as a default arrangement, and the restriction for just a maximum of two dining at their outlets now. But in terms of our outlook, we are incrementally more positive as Singapore moves into endemic COVID-19. We think that barring a massive breakout, it's quite unlikely that we will go into the kind of lockdowns that we see that we saw earlier in the year. The costs, we also expect Koufu to see some cost synergies from the move into the integrated facility, in terms of cost synergies, in terms of bulk purchase and also the rental costs as well. We also expect to see the Macau footfall to improve with more border easing on the mainland China front. So in terms of our next slide, in terms of our recommendation, even though we are incrementally a bit more positive, we maintain our neutral rating and unchanged target price of 64 cents. It's still based on 18.5 times financial year 21 PE. The reason why we are still neutral, even though we're more positive, I think is because we are still cautious on the reopening roadmap due to a resurgence of COVID-19 in Singapore and China. We think that they want to open, but the high COVID number count will slow down the reopening. So we are still neutral, but we believe that the stock could potentially be re-rated if there's further relaxation of dining measures and also an increase in foreign travelers to Singapore. So that's all from me for Koufu. We'll cover the Singapore Banking Monthly for August. The title of our report is Stable Outlook. So we expect a more stable outlook for the second half of 2021. When we look at the local lending rates, this was flat in July. Interest rates for the 3-month SIBOR and the 3-month SOR was flat at 0.43% and 0.28% respectively. Even though lending rates were flat, but loans growth was overall healthy. For Singapore, they saw loans growth of about 3 to 3.5% for the full year, on a year-on-year basis when we look at July. The banks also resumed their pre-pandemic dividend payout, with MAS lifting the restrictions on the bank's dividend distribution. All three banks reverted to pre-pandemic payouts. We talk about some of the dividends that they distributed, but we've covered this already, so we'll move on. Next slide. We also provide a overall summary for their second quarter 21 results for August. Overall, we'll be brief here because we covered, but the NIMs were overall stable. If you look at the table here on your left-hand side, you can see that the NIMs has stabilized around 1.45% to about 1.58%. Even though the NIMs were stable, the loans growth actually grew in the second quarter of 2021, and they averaged about 3 to 5% for loans growth, which is relatively healthy considering some of the lockdowns we experienced in the first half of 2021. Net fees and commissions were also above expectations, even though if you look here on the table on your left-hand side, on a quarter-on-quarter basis, you see loans growth trending down by a single-digit percentages rather. But the net fees and commissions were still above expectations. This is because of the high base effect in the first quarter of 2021. So we were not surprised to see the net fees and commissions coming off, especially because of the very strong non-trading income in the first quarter. So even though you see a single-digit percentage drop in the second quarter, but on a year-on-year basis, it still grew about 20% for the three banks. The general provisions were also lower for DBS and UOB, even though OCBC did see higher provisions. So if you look at again on the table here, you can see DBS is the only bank, also similar to first quarter, that reversed some of the general provisions that they made for first quarter of 2021. The CET1 ratio is also comfortably above their general operating range, the range that they operate in, which is about 12.5% to 13.5%. So if you see their CET1 ratio in the last row here, is about 14.2% to 17.5%. In our next slide. Yeah, thank you. The domestic loans growth rebounded in June. Domestic loans growth grew 3.5% on a year-on-year basis, above our expected range of 2 to 3% for 2021. This was driven by business and consumer loans. Business loans contracted 0.5% year-on-year in May for the 9th straight month because of loan demand for manufacturing, transport, storage, communications, and business services dropped. But this fall was a little bit better than was expected. Consumer loans were also up 0.3% year-on-year for the 10th straight month, aided by its largest segment, the housing segment. Overall loans growth grew 1.5% for the 7th consecutive month, up from 0.2% in May. In our next slide. In terms of recommendation for the banking sector, we remain overweight on the banking sector. Even though the banking sector is currently trading close to or below our price to book targets of 1.17 to 1.36 times, we have seen them trade above 1.4 times in the past 5 years as well. So for us, we are positive on the banks because we believe that the banks will, for the second half of 2021 and also for 2022, it will be supported by improving ROEs from the reversal of general provisions and improving net interest income and the fees income as well. So this will support the special dividend payout that the banks will likely make to maintain the ideal capital structure. So the banks are currently exploring a few ways to optimize their capital. A special dividend payout is one of the ways. The second way that they are also considering is doing some M&A, and this is what DBS has done in the last couple of months. Of course, what the banks are looking at now is to look at some of the assets up for sale, and for those who follow the banking sector, you all know that they are looking at some of the assets from Citibank. So if they are doing due diligence on this now, and they're likely to table a bit if we meet some of their expectations as well. Otherwise, they have not ruled out paying a special dividend, but they are more likely to do so when the outlook stabilizes. So in terms of sector preference, we prefer DBS, which is also in our absolute 10 portfolio. We prefer DBS because we expect the better earnings growth from their wealth management business and investment banking business, which will drive record earnings in FY21. That's all from me for the banking sector. I'll now hand over the time to Timothy.
Yeah, thank you, Terence. We initiate coverage on Apple Inc. The title is Super Cycle for Price, Margins, and Product. Apple is listed in the Nasdaq in the US. So just some background. Apple generates revenue. 50% of revenue is from the iPhone, 9% from the iPad, 10% from Mac and MacBook, the laptops, and 11% from the wearables and home accessories. These four segments, iPhone, iPad, Mac, and wearables, make up their product segment. And lastly, they generate 20% of revenue from services, which we will touch on later. The markets they serve is in the Americas, 45% of revenue, followed by Europe, 25%, China, 15%, and then Japan, 8%, and the rest of Asia, 7%. So for services, how they generate revenue there is from the App Store, licensing, Apple Care, and then followed by iCloud, Apple Music, TV, and iTunes. So the main driver for the services is App Store, which is where people download all their apps from. So Apple generates 30% of all subscription fees and all the in-app purchases that people purchase from the App Store. Second, licensing is they generate revenue from the licensing fees paid by customers such as Google to be featured on Apple products. And lastly, the Apple Care is their extended warranty services where they collect a fee for an extended warranty. So our main thesis for Apple, the first main thesis is that 5G will drive record iPhone sales. So we see 5G to drive record iPhone sales both in FY21 and FY22, and topping the record number of iPhones sold back in 2015, during the 4G super cycle, that time when everybody was upgrading to 4G. So back in 2020, when Apple launched their iPhone 12, the iPhone 12 was the first 5G phone that Apple released. And this phone hit the 100 million unit sales milestone 2 months earlier than the iPhone 11, with 5G as the key reason for customers upgrading to the new iPhone after years of holding back. They're replacing their old iPhones. So in context, Apple generates iPhone sales comes from about 80% of iPhone sales come from upgraders. So usually people are holding old iPhones and then they upgrade to the new one. So most of the sales come from these upgraders. And about 48% of iPhone users still use iPhone 10 and older. So Apple is targeting all these 48% of iPhone users to upgrade to this 5G technology. And that's why we're expecting a new super cycle in iPhone sales. So for the iPhone 13 that is expected to launch this month in September, Apple expects it to do even better than the iPhone 12. And they ordered 25% more A15 chips for the new iPhone 13, which is 25% more than last year, the 2020 iPhones. So just a reminder that iPhone is Apple's main cash cow at 50% of FY20 sales. The second thesis is we expect margins to remain elevated. This is because of two reasons. First reason is because of the services segment. So the services segment is growing at a much faster pace than the iPhone. It's growing at about 17% compounded annual growth rate. This is due to the ever-growing installed base. Installed base meaning people that own iPhone products. So people who own iPhone products tend to use more of Apple services, and that's how they generate more revenue from services. So this number of users topped 1.65 billion in January 2021, and it's ever growing every year. So the guidance from Apple is that double-digit growth is sustainable moving forward. So some context why we expect margins to remain elevated is because the margins from services, which is growing really fast, is more than double the margins from the product side, which is 66% versus 32%. So the second area where we expect Apple to get the higher margins is from the 5G products. So the new 5G products that was launched last year allowed Apple to raise its weighted average selling prices by more than 20% from a year ago. So altogether we expect both of these areas to help Apple's margins to remain elevated moving forward. So we expect margins to track above 40%, both in FY21 and FY22, higher than the 5-year historical average of 38%. Next slide, please. Okay, and the last thesis is that Apple's gaining market share through supply chain dominance. So in the current moment, there's a semiconductor chip shortage. There's a global semiconductor chip shortage. So this doesn't only affect the small players, but also the big players in the high-end smartphone market. So Apple's key competitor, which is Samsung, was hit by factory shutdowns. So their Texas semiconductor fabrication plant was hit by a month-long power shutdown, followed by the COVID-19 affecting their Vietnam factories suspensions. So Samsung actually is going to delay their Galaxy Note's launch second half of this year as a result of this shortage. On the other hand, and because of this helps Apple's market share of the global smartphone sales to reach 5-year highs since the fourth quarter of 2020, hitting 21%, a historic high, a historic 5-year high. And in some context, how Apple manages to mitigate some of these supply chain issues at the moment is through their very strong buying power of suppliers. What they do is that they purchase in very, very large scales and give up upfront cash payments to the suppliers. So competitors will have lesser capacity available to them from these suppliers, and this will leave them handling price shocks and shortages created by Apple deals. So on the chart on the left, and the charts below will illustrate some of these theses. So the first chart on the left shows us the number of iPhone sales that we expect both in FY21 and FY22. So the previous super cycle back in 2015 was the 4G upgrading super cycle. So we expect these two, 2021 and 2022, to both see higher iPhone sales than the 4G super cycle. The second chart on the right shows the high margin services, shows how fast the services segment is growing. The services segment is the red in color area in the columns, and the dark blue area is the iPhone revenue from the iPhone. So you can see that the services segment is growing much faster than the iPhone, and that's where we expect higher margins for Apple moving forward. Okay, next slide, please. Okay, this is the last chart. It's a bit complicated, but if you focus on the last 3 columns on the right and the black in color area, 21%, 17%, 15%, those are the most recent 3 quarters from the global smartphone market share numbers that we have from Counterpoint Research. So amidst this semiconductor shortage period, we see that Apple's market share has been breached 5-year highs compared to the previous quarters, both in quarter 4 of 2019, first quarter 2020, and second quarter 2020. So there is 21% versus 18%, 17% over versus 14%, and 15% over 14%. So it's not only just one quarter, but we see a sustained higher market share of the global smartphone sales, and having the supply chain dominance has helped them to achieve this. Okay, next slide, please. Okay, so we initiate coverage on Apple Inc. with a DCF valuation of $187. This is compared to the last done price of 154.30. This is based on a WACC of 5.8% and a terminal growth rate of 3%, based on the 10-year average US GDP growth rate. With that, I'll pass my time on to Paul. Thank you.
Thanks, Timothy. I'll move on to UGHealthcare results, the Malaysian glove maker. In terms of the results, the results was good. You can see the revenue is up 60%. Gross margin, PATMI is up 73% year on year. It was in line with our expectations. I think almost to the dot. I guess like 3% off our full year numbers. The positives was the new capacity that was installed. There was a 20% expansion in the capacity April this year, but you won't get the benefit of the new capacity but only in FY22 because of all the issues in Malaysia, the enhanced movement control, the shutdowns and so forth. So you were only they couldn't really utilize the factory that well because of all these controls. The negative is the quarter-on-quarter weakness. So you can see the quarter-on-quarter, sorry, there's no red bar here, but the PATMI was down 14% quarter-on-quarter as we start to see glove prices start to deteriorate or decline. So in terms of the outlook, I mean, the numbers were good, but the outlook is where it gets a bit hazy. What's happening is that glove prices is likely to fall in the first quarter 22, which is the September quarter. And we also worry that the glove prices may fall again in the December quarter. What is happening right now is that as the prices are falling, the distributors and customers are just winding down their stock. As you can imagine, if you're a distributor, you take the stock at $80, then next 2 months it dropped to $60. You can imagine the losses they face. So a lot of the buyers are just hesitant to buy. So I think they're just buying as they for whatever needs they have because the prices have been coming off. What worries me, at least as we go into the September and December quarter, is because the prices were declining, even though the Malaysian capacity was kind of curtailed. As you know, Malaysia, there was a EMCO where they shut down. Then even if you turn on, it's based on your number of workers that have been vaccinated. So, you know, it's 70% of the workers vaccinated, then you can operate 70% capacity. And the other thing is we worry of the aggressive pricing by the Chinese manufacturers. The positive for UG, so I go back to the slide, is that there is an expansion in capacity. I mentioned 20% in FY22. FY23, you'll get another 35% jump. This is effective on this, so you actually get the full benefit. So there'll be another 35% jump in capacity. So that's the offset for them in terms of the weaker prices. We downgrade to accumulate with lower target price. We cut our FY PATMI. Our assumption for glove prices is really cut it down to 50, which is more or less where the market is trading right now, roughly. And also, how we get our 63 cents, again, how we benchmark is we use relative valuation because since there's so many glove manufacturers, so you can use PE because there is an industry norm, I guess, in terms of valuation. So, but we're just taking 30% discount to the big four Malaysian glove makers like Top Glove, Hatta Lega, Supermax and Kosan. Why 30%, not 20%? It's just that this has historically been the discount that's been trading roughly. So this implies a forward PE of 8 times, and that's how we get our target price. Next slide. Okay, sorry, I'm not sure whether I'm getting this, but next slide. Yeah. Next. Okay, in terms of our usual just updates, in terms of the numbers in Singapore, the macro numbers, it's still quite healthy. The PMI is 50 and 51, so it's still there. For retail sales, I guess the one to take note of is we got our July retail sales is only up 2%. I think it's back to normal. That was the trend growth in retail sales, ex motor vehicles. The one that was interesting for me was at least the supermarket sales. You know, July is always important, July, August, because we get a peek into third quarter September results before the results are out. So at least we can. So right now, third quarter looks healthy for the supermarket because it's up 4%. And you know, you're comparing against last year when everything was elevated, all supermarket sales elevated. The other thing is just this is just for info. It's seldom mentioned in the press, I guess, but there is this thing called average monthly earnings in Singapore. This is basically earnings by CPF contributors, excluding sole proprietorship. So for that, there was at least some good news. There was almost a 4% jump in earnings, and this is the highest in 7 quarters. I guess this is positive, I guess, for property or just the whole domestic economy in Singapore. In terms of US, the big news all over, I guess, all over the papers was the weak payrolls numbers. These are private payrolls. It was only 235,000 new jobs added versus expectations of 800, and the month before was almost 1 million. But do know that it's not that there are no jobs out there. There's almost 10 million job openings. But just that there are a lot of the jobs are being unfulfilled, not fulfilled. I think we'll show you a chart later. And one of the reasons is, I guess, just hospitality and leisure. But I guess it's maybe because of the pandemic, so people are afraid to go to take out a lot of these jobs. The unemployment rate is still trending down, which is a positive, and it'll be interesting if whether they meet the Fed's forecast, because that will determine also the level of tapering. We'll discuss later SPH and Isoteam. In terms of our tactical views, very near-term tactical views, I think we still think at least the Singapore market is going to trade sideways. The macro is a bit fluid. So growth rates, the view now is growth rates have peaked. I saw some of the Chinese numbers. We also track them. Maybe we'll show next week, but everything is slowing down in China. Of course, there's still growth, but they're slowing down. There's also worry of tapering, how it's going to affect the markets. But interesting to note that the last time we had a taper, rates actually came down. Then also there's this unknown about inflation. Where is it trending? I think that's the biggest worry. There's also a bit of nervousness right now because the Democrats may not pass through the 3.5 trillion kind of stimulus by Biden. So you got all these kind of macro nervousness, which probably just makes us think that the market might trade sideways in the very near term. In terms of POEMS webinar, for those interested, we have CIFMET, Australian engineering company, LHN, which we have coverage and we have a buy call, and then we have CSE Global on Friday. So these are the ones that we have for this week. So if you have time, feel free to join us. And these are the rest. I think the big ones will be like Comfort, Delgro, and so forth. Next slide. Okay, as usual, we just get a quick update on the COVID-19 cases. So globally, the good thing is starting to slow down. So we're only growing about 4%. There is a worry that when back to school happens in the US, there might be another spike in US, and that could again kind of affect people's expectations of growth. Next slide. This is just the usual, but you can see the vaccination in Southeast Asia, apart from Malaysia, is still very slow. I think like Thailand, Philippines is only like low double-digit vaccination, but you can see the cases now in Philippines are surging quite sharply. Likewise in Malaysia. Next slide. For Singapore, I think we got the bad news is that we got a record high in cases, especially on the 7-day moving average. So I think we're like, 180, but 3 times more than the circuit breaker time. The good news is just that there's only 5 in the ICU. Okay, I did listen to, as usual, to the ministry task force. I think the question most asked was like, why are we not relaxing more, opening up more, since we already hit the 80% second dose? The response is just that there's some time lag from all these infections to serious illness, which is what the so-called ICU barometer. And the authorities also said that they're always taking it a step-by-step approach. So I think the key message is this doesn't derail that there won't be, that there will be again lockdowns. I think it just says that they're a bit more cautious, but the reopening is still on track. But just that they just want to be a bit more cautious now and see how all these cases are trending in terms of the serious illness. Next slide. Okay, Natim, just wanted to show you, we always hear that there's a lot of job openings in the US, but if you want some data, this is it. The blue line basically shows the huge amount of openings. So if you refer to the left-hand side, you can see it's hitting 10 million. It's a record high. Even 2006, when times were so good in the US, is only about 5 million. So it's like double the amount of job openings. Even though the payrolls have down, but the openings continue to escalate. So a lot of jobs are not being filled in the US, if you look at this. Next slide. The chart on the right is just to show you that we've not really recovered from we still 5.3 million jobs after the 20 million jobs lost in the US is still net 5 million down. Yeah. Next slide. Yeah, sorry for that. Next slide. Okay, in terms of SPH, this is Poem's webinar. The whole focus of the webinar for those who did not attend was all about the EGM coming about selling off of the SPH media assets. The table on the right is just the timeline. So we have an EGM on the 10th of September. There's 2 resolutions. In nutshell, the first resolution is just to remove the media business. The second one is to remove this management shares, which I will discuss later. Anyway, there are 2 parts to this, just as a refresh. The first part is SPH will transfer all their media assets into this entity called SPH Media. That will include the 2 properties worth 142 million. They have to transfer the properties. I mean, this is where they produce the newspapers, so there's no choice. So once all this is already hived out, they're going to capitalize the SPH Media. They're going to give SPH Media cash of 80 million, some SPH REITs, and also SPH shares also. The value is all there. So in total, I think it's about 200 plus million. So this would cause the NTA to drop about 16 cents, about 7-8%. Of course, the main question everybody asks is, why you want to give away 200 million for what's the reason? Why don't you just close it or whatever? But firstly, the liquidation might be even more costly, provided they can. Secondly, there's limitations in selling, so they can't go out there and just have a tender, everyone bid, because under the Newspaper Printing Press Act, nobody can own more than 5% without the authority's approval. So you can't sell this thing, basically. Who wants to own only 4% and get any control? The other thing is this thing called management shares. Just a reminder that management shares means they call it the super voting rights. Management shares, they have 200 times the vote. So if you have one share, you have times 200 in terms of your voting power. But this is mainly for the board management. You can vote on the composition of the board. So those who have these shares are like the 3 banks, NTUC, you can see all that. So resolution 2 is just to remove this so that they all become ordinary voting strength. So if Singtel has 1 million shares, they can only have 1 million votes, 1 million based on the percentage, not 1 million times 200. Okay, I won't run through, the rest is there, yeah. I guess my only takeaway is that without this deal done, you won't have at least the optionality of taking up the capital offer. So if this thing goes through, you have at least some upside optionality that you can at least take up the capital offer. Next slide. Okay, next one, my final slide is Isoteam. This is a very small company, but I just wanted to talk about it just to show you how challenging it is for the construction industry. So the chart on the right basically shows what this company does. We always found it interesting. They got, like, for construction, they got very recurrent earnings, because what they do is, town councils will need to repaint all the HDBs every 5 years. Then they will bid this job. Then there's this M&D. The HIP means home improvement. Basically, just change everyone's toilet in a nutshell. And they also are involved in that, and there's a lot of jobs and opportunities for that. Of course, hawker upgrading and so forth. So what has happened is that this is their 2nd year of losses. So they lost 14 million. I think last year was even worse. So the problem they have now is huge cost challenges for them. Just to give you a flavor, they lost like 30% of their workforce. So basically, they are down 30%. The ability to execute jobs is down 30%, and they outsource. I think more than 50% of their work is subcontracted out, and amongst that, maybe 10% to maybe 20% of the subcontractors are facing difficulties. Whether they're closing down or they just cannot execute because the costs are all shot up. So the third challenge is all these productivity issues. You have to go for vaccine. You have to go and do all this testing, which the workers are probably half a day away, cannot do any work. Then, of course, you have manpower cost increase. They just gave an example. A plumber, maybe 120 days, $120 a day, now almost doubled to 220. Raw materials all jump, steel costs. And the problem right now is that it's hard to claim all these cost increase. So just to give you some sense, maybe they make 20% margin the cost on average rise 30. So any job they took now they lose like 4%, not to mention the operating costs. This one just to note that I think HDB maybe cost 100,000+ per unit. The cost is probably now doubled, and probably contractors are not willing to take it out because there's just so much uncertainty about how high costs will occur. You cannot get manpower to even execute the job. So the curious thing is that although they have got like 165 million order book, the problem is half of it from circuit breaker means half of it is almost a certainty it's all loss making. Yeah, the rest is they are also involved in solar installation. You know, Singapore has plans to put solar panels on all the HDBs. They also have this bike sharing. But anyway, just wanted to show you how challenging it is if you're running a construction business right now. There's all kinds of costs which you cannot pass on. Okay, I think that's it for me. I think we can move on to questions. I think Viren, you go first. There's a lot for you. Yeah, thanks.
Yeah, I'll go first then. Just give me a while that a new share. Yeah, some questions on the technicals. First of all, I think look through it. There are some huge local counters. That's being asked. So for Capricorn, I remain neutral on that. Despite that, previously I was so confident that it actually.
There's a beating sound on your side. Can you mute and unmute again? Because there's a noise.
Okay, sure.
Yeah. Okay. Okay, it's better now.
Yes. Okay,
Oh no,
sure.
no, I think it's still happening. The beating noise.
Oh, I think it's nearby construction near my place. So apologies.
Oh, okay,
for that.
okay.
Yeah, apologies, guys. So for that, right? For Capricorn, although the rebound from the upside to 5.48 to 5.56 was like a strong rebound, but it fails to break the resistance zone here. So therefore, the smaller correction actually has halted Capricorn from going further. So I remain neutral on that.
Oh, it's very hard to hear you, because the noise is very tough. Yeah, can you try again?
Okay, guys. Sorry.
Yeah, I can still hear the noise. Yeah, I think we will take on the is your mic? Yeah, I think we will take on the other questions first. You just be a while and log back in. Okay, Terence, can you take on some first? Yeah, as we wait.
Hello. Yeah, maybe while Raymond fixed his mic, I'll take on some of the questions here. There's one question on Koufu. With referencing Koufu, based on your investment recommendations, what are their peer competitors? Example, Kimley, in terms of investment options in the industry sector. So I think what you're asking for is whether Kimley is a better, you want to compare Koufu and Kimley. So we don't have any coverage on Kimley, but in terms of but we can comment on Kimley as well. So when we compare Koufu and Kimley, they operate almost similar business models, but Kimley's business model is a little bit more resilient when we compare their business model versus the Koufu, because there are two main reasons for this. Firstly, when we look at Kimley's geographical outreach, they are mainly in countries like Singapore, and in the industrial canteen areas and in the heartland areas. So versus Koufu is in Macau and in Singapore as well. So in terms of geographical location, Kimley is more focused on Singapore versus Koufu, where you have the geographical risk in Macau as well. The second reason is that in terms of the local countries that they are local outlets in which Kimley is situated, they're located in some industrial canteens and in the heartland areas versus Koufu, where you see their outlets also in the schools, like SMU, they have one in Marina Bay Sands, in terms of their Rasapura outlets, and also in some of the office commercial areas. So their business then gets more affected by work from home than Kimley. So Kimley is then a more resilient business, has a more resilient business model than Koufu. Yeah, so I don't know if I answered your question, but let me know if I didn't. Yeah, thanks. That's all for me. Thank you. I hand over to my other colleague.
Let me try my mic. Is it still the same, Paul? Anybody can comment? Is it better?
Yeah, it's still a tapping sound. I think it's the connection.
Okay, then I guess then I cannot proceed further already. So any Q&A, I can't proceed for now. So sorry.
Timothy, you want to go ahead?
Yeah, okay. Okay, on the question on Apple services, have you factored in the recent development of limiting Apple's charges commission cuts on SW or on services sold via the App Store? Okay, so yes, with regards to the new rules with regards to the charges and the commissions cuts, just some context, the App Store is the main contributor to Apple's services revenue. And services makes up about 20% of Apple's total revenue. And so this new move by Apple recently, just to let everybody know, Apple has allowed customers to sign up for reader apps such as Spotify and Netflix, all these reader apps on the respective company websites and not on the App Store. So in the past, Apple didn't allow them to do that. Also, they only can register on the App Store, but now they can just register on the Spotify website, on the Netflix website. So in this case, Apple won't be able to get the 30% cut that they get from these subscription fees. But what Apple generates revenue from is not from these reader apps like Spotify and Netflix. So they mainly get money from the App Store through in-app digital goods and services. So it's when people purchase things in the app, and this mainly comes from apps like gaming apps, where they offer a lot of in-app things to purchase and stuff. And Spotify and Netflix, they don't really have this kind of in-app purchases. They just have this recurring subscription that happens. So that's not that doesn't get to the heart of where Apple makes money from the App Store. So we don't think that the impact is going to be that major. Okay. The second question is, who is supplying the chips to Apple now, particularly for iPhones? Are there any factory disruptions due to COVID-19 or parts shortages or delivery disruptions? So the main supplier for Apple's iPhone chips now is TSMC. So they ordered 100 million chips from TSMC for the iPhone 13, the A15 chip. And yes, based on Apple's guidance, they do expect supply impact on the iPhones moving forward from this the semiconductor shortages. And we have already included that in the estimates, and as well as consensus estimates in the market as well. So the Apple guides around 3 to 4 billion of impact from the supply shortages, which is about 1% of revenue. So that is the estimated impact. Okay, and the last question, your analysis for Apple focuses mainly on the outlook. Could you share something with us from the valuation perspective? Is the share price too high? Thanks. Based on the current PE now for Apple, we use a DCF valuation because Apple is a very, very stable cash flow generating company. So we use a free cash flow DCF valuation. But based on a PE perspective, it's in a historically high area for Apple. But however, we need to take this in context that it's pricing in a new technology super cycle. And we also expect record revenue and margins to remain elevated. So in that context, I think the share price is able to, there's the upside from the high valuations as well. From the PE side, the DCF side, we have a higher valuation based on the DCF valuation. Okay, thanks for your question. I think that's all for me.
Let's try again. Is it better now? Any sounds?
Yeah, strangely.
Is it better now, Paul?
A little bit better, but you can still see the tubbing sound. I think it's the connection to your phone. I'm not sure. It's the
Okay,
connection to
let me see. Okay, so okay, I try my best because I changed some of the mic content and stuff like this. So
maybe just do one or two is fine. Yeah. Yeah. I don't have to do the whole thing. Just do the banks, it's fine. Yeah.
okay, just give me a moment. I disconnect audio first.
Okay, as we wait for Wei Ren,
Okay.
it's much
Yeah.
better now. Yeah, much better.
Yeah,
now.
I use my phone to do it. Anyway, you can use the you can look at Capricorn. Capricorn, I think I remain neutral. From what I mentioned earlier on just now. Going forward. So let's move on to venture. Okay, venture. I did issue a report on that. I think quite some time ago. You can see that there's actually a falling wedge forming. Okay, so price may have an additional upside, but the upside may not be that long going forward and stuff like this. So hence, I remain neutral for venture as well. But I can see that the one thing I can be sure is that the multiple testing of the intermediate resistance zone is kind of like weakening at 19.33 to 19.54 on that. All right, so with that, I will just see how is it like. Okay. The next thing is the Xiaomi. Xiaomi, I think I remain bearish, especially today. The bearish sell down below the 200-day exponential moving average and stuff like this. So I think Xiaomi will have some further correction. Despite that, I think we are looking at larger corrective ABC down to 18.55 to $17.50 going forward. All right, the next one is actually 6060. For this, I really don't have any comment on now. Looking at a larger trend is on the downtrend. Currently is a larger head and shoulder, so hence not much upside I would have seen, and especially this is actually a corrective bearish flag. All right, let's move on to the banks. Okay, so the banks actually is rebounded at a multi-support, but however, if price do not clear $31 above strongly, then the threat of a head and shoulder formation is likely to be formed, and with that formation, I think price is going to threaten to go down. And should that happen, then we'll see 27.29 region as a very strong support for a rebound. So for OCBC, I'm still targeting, I think, a larger rebound from support zone at $11 to $11.23. This is what I will expect going forward. Especially there's a false bull threat without breaking the resistance zone. This is likely same with the UOB Bank. UOB Bank also a bull threat, and then price come down with a three-way correction. Upside may see further testing at $26 before going down to major support zone before rebound. That's what I believe for the banks. If you ask me all the summary about the banks, I think it will be very range bound, range tight for now, and then look out for $23 and $28 that region for UOB. All right, next I'll go to JD. Honestly, the Hong Kong stocks, I think for the Hong Kong stock, I think prices has been doing well. The good news is for this JD, price actually has a doji, and then price have a sell down. Double bottom is formed at which is at a major support zone. But price is looking to break the next resistance zone going forward. If this bullish candle is likely to form, then we are expecting price to break up further to test the upside. So 315 to 324 likely to be broken, provided that the bullish candle is still forming over here as well. Hong Kong Exchange range bound, not much of momentum going forward. And then lastly, HST. So for Hang Seng Tech, price broken out of the falling wedge. looking at a V-shaped rebound, bullish divergence, but price need to break the multi-year multi-resistance at 1.71, and then next resistance to be tested is 1.243 to 1.277. Next one, I'll be answering on Thai Bev. So for Thai Bev, price rebounded, inverted head and shoulder. However, I think to be able to confirm this formation, immediate resistance at 0.71 to 0.715 will need to be broken on that. MM2 Asia, I have no comments on that. Thank you. So let me see on any. Okay, I'll share on Silver Lake Axis, and then I will. So Silver Lake Axis, I think there's a still further bullish upside. Paul did a prelim on the ground last week, so hence this panel has been broken. But however, I think the confirmation will come when it break resistance zone at 0.290 to 0.3. However, as my swing line arrow indicate, I'm highly confident that you will break up on the upside going forward. Then Costco 1919, let me see. Sheng Siong have no, I think Costco 1919 still same as last week. All right, diamond top pattern. Although it's still on the uptrend, but I think momentum has been weak as displayed by the 63-day moving average. 1799. Okay, 1799. Price still on the upside, but resistance at 25.75 still remains. All right, and then lastly, Yangzijiang. So Yangzijiang consolidation, wave 5 has been met. So expect some sort of consolidation for Yangzijiang going forward. All right, so with that, I have answered most of the technical question. And then if there is, then because due to time, I think I need to pass my time. There's still other further questions for my colleagues as well. So yeah, pass my time back to my colleague. Thank you.
Natalie, you want to comment on the capital land and all the other questions?
Hi, good morning, everyone. Okay, so there are a couple of questions for me. I will take Mapletree Commercial Trust first. So the question is why Mapletree Commercial Trust is relatively weak. Okay, so for the first quarter ended ended June. So this will be their first quarter because of the different financial year end. Overall, this was the quarter that had the impact from, ended June, So this is the quarter that had the impact from the phase 2 heightened alert. So in general, in terms of their retail portfolio, this was quarter on quarter, it registered lower revenue as well as NPI from the retail portfolio on a quarter on quarter basis. However, of course, the amount of rental rebates that were offered this for the period of April to June 2021 was comparatively lower than the amount of rebate that was offered this time last year. So that is a small positive. But of course, moving forward, any tightening in these COVID restrictions or COVID measures will of course have some impact to the trading of the retail tenants, and that might actually warrant more rental rebates to be offered. The rest of their portfolio, which comprises of business parks, I think there was a slight increase in the occupancy for most of their portfolio. However, there was a pre-termination at M Tower, and this pre-termination, the positive side is of course there was some pre-termination revenue, or rather, the compensation from the pre-termination. So that actually helped to lift NPI and revenue by about 7.7% thereabouts. Yeah. So I think overall, for their retail portfolio, which is a relatively significant portion, the retail asset, VivoCity comprises a relatively significant portion of their portfolio. And this mall is, quite reliant on tourist tourist spending. So we estimate that about 30% or more of this business is actually contributed by tourists. And as we know, the international borders still remain closed. Yeah, so there's going to be a little bit of weakness from this. Okay, and then I'll move on to the next question. Next question is okay. This is half of this question is for Paul, which is on Q&M. The other half is for me on CapitaLand. So for CapitaLand, just some updates in terms of the timetable. As you know, the EGM for this demerger has been approved. So the expected day of last trading of CapitaLand shares would be in 3 days' time, 9 September. And also the expected date for the payment of the cash consideration as well as the distribution in specie for the CLI shares would be 17 September. Okay. So for those of you who are concerned about odd lots, you can actually and you have an account with us, there are actually preferential rates for odd lots for the period of September 17 to 15 October. In terms of performance for CapitaLand, in terms of how operational performance, okay, so for their residential or rather development segment, is relatively strong. Of course, Singapore is one of the contributing factors. We know that the Singapore residential market has been relatively buoyant. Okay, in terms of their retail and their office portfolios, of course, this is we have seen a quarter-on-quarter improvement in operation metrics. Yeah. Okay. Yeah, and for this year to date, CapitaLand has been very active in terms of divestments. So a lot of their divestments, be it to their REITs or to third parties, they have been accretive. Yeah, and so that will of course increase the NAV of if these assets are from the CapitaLand CLI bucket, that will increase the NAV for CLI portion. Of course, we are now moving forward. We will be focusing our valuation on valuing CLI instead of CapitaLand. So we're in the midst of that. So we hope to update you on that in the coming weeks. The next question will be for Manulife REIT. It has been weak lately. Please comment on the potential upsides with the reopening of US. Okay, so for for Manulife, located in the US, and for the US, within the last year to date, their physical occupancy has been relatively low, 5% to 15%. So what that means is that the office buildings are virtually empty, and that will weigh on your car park income, which has taken a hit. Car park income actually contributes about 7% of revenue for Manulife. Okay, so of course with the reopening, we expect more return to office to actually lift of course the car park revenue, and also probably lift the trading of some of their ancillary retail tenants who are located within the building. So that of course would mean that probably less rental support, rental relief, rental rebates will be offered for tenants as their trading improves. Okay, so that being said, actually the rental rebates is not a very large amount. I believe it's about 2%. Okay. Another thing that we are seeing with Manulife is that, in terms of leasing, while there has been uptick in US office leasing, quarter-on-quarter improvement, however, as compared to pre-COVID levels, it is still somewhere around 30% below the pre-COVID levels in terms of leasing. So in general, because of the high vacancy in the market, vacancy is currently about 17% on a market level. So the relatively high level of vacancy, as well as a little bit more caution from the tenants, this has led to a more competitive kind of leasing environment. So we expect leasing to be still relatively weak in the near term. So in terms of the US office REITs, for those under our coverage, we prefer Prime. This is of course due to their larger exposure to your new economy sectors. So the new economy sectors are, like, for example, your biomedical, those that are in media advertising, the new economy, the tech tenants. Yeah. So because these trade sectors are sort of in their expansionary, or they're doing relatively better than the other banks and the legal firms that are actually, starting to look at right sizing their space. These new economy tenants are the ones that are able to offer a better rental rate. So that will of course lead to rental growth for those assets that are actually able to capture the demand from these new economy sectors. So that would be prime, of course, and those that are not under our coverage, for example, your Keppel Pacific Oak, they also have, Keppel Pacific Oak also has a relatively large exposure to these tech and biomedical tenants. Yeah. Okay, so so overall, to wrap things up for the Manulife side of things, we do expect some improvement. However, of course, we are very wary that the leasing environment might actually hinder the recovery. Another thing to note for the US market is that the way the leases are structured, there is of course, in Singapore, we know that every time you sign a lease, the landlord might offer you some kind of rent-free period for you to do your renovations before you move in. So in the US, there is this rent-free period, as well as this component called tenant incentives. So what this tenant incentives is basically a fund that the landlord will put aside for the tenant to tap on, to use for their renovations or improvements further down along the lease term. Yeah. Okay, so this component of rental rebate, of rent-free period as well as tenant incentives, that will actually lower the net effective rent. Yeah, so it means if you were to average the amount of rent paying months plus your non-rent paying months, and you average that including your TIs, that currently where we are right now, it is still about 15% below pre-COVID levels. So while the rents are slowly recovering, the overall picture is, if you look at it with the rent-free period as well as the tenant incentives, we are still not yet back to pre-COVID levels. Yeah, so there's still some ways to go. Okay, so that's all from me, I think. I'll pass the time back to Paul for now.
Yeah, thanks, Natalie. I think the interesting thing about CapitaLand now is the valuation metrics. So in the past, CapitaLand is always kept. The price always kept because it's either 0.8 times book, 0.9 times book, and there's only a limit to how much it can go. But once you move the valuation metrics to PE, so can it be 18 times, 20 times? So it can break out from this this kind of ceiling in the price. And the second thing for CapitaLand is that you will be, at least the next 2 years, there should be some very strong growth because they are the original reopening stock, because they were the worst hit. Their exposure, like Keppel, is like malls and what was that? And hospitality. Yeah. So these are the worst hit sectors, like the center of the earthquake. And so when all this reopens, you should see strong growth for CapitaLand. And then once you do on a PE, then people, when there's a growth comes into PE, then the valuations can be quite high. So in that sense, the whole rating, the whole view on CapitaLand can change once this whole deal is done. Because I saw someone ask whether should we sell. I don't know, my own view is we shouldn't. I think it's an interesting stock now, especially once they unshackle this kind of limitations to valuing them with a property developer. The other question on Q&M, I think the market is just waiting now to see how well the dentist volumes will grow now that you have off this. Once you've gone past this, because last year was very bad, so now you've gone. So people are just trying to watch for the trend line growth after the post-pandemic big rebound that you had post-pandemic. So people just want to know what is the trend line growth for the second half, and also the reopening. So I think there's a bit of hesitancy on the stock right now because of that. The whole thing about, they also benefited from PCR testing, apart from Raffles Medical, but I think right now testing is still there, but I think the market is again just unclear how long the testing will be. But I think you can see from the Ministerial Task Force, there's going to be aggressive testing still going to be done. So we are still positive on Q&M, but admittedly, we know that the market is just waiting to see how the dentistry volumes and so forth, like we just mentioned earlier. I hope that answers it. Let me just run through one more thing before maybe Terence has something on the banking side. Next one is hi Paul, because this was an early question. I would like to request your team to reinitiate coverage of Geo Energy with ICI4. ICI4 is a coal price at 10-year highs. Geo should be a good buy now. Yeah, the problem we have when it comes to initiating commodity stocks, of course, the best should have been initiated early this year, and then we probably downgrade to neutral now because it's the coal price is probably tripled. Just to give you some sense of why it's challenging for us to cover, because in 2018, coal price was 100, then it dropped to 70 in 2019, then 2020 it dropped as low as 50. If we initiated in 2020, nobody would believe us. Then unless we initiated early this year, when the prices were maybe 60, 70 coal price, and then now it's like, I think now coal price has tripled to 150. Yeah, but if we initiate now, we have to take like a 2-year view, or at least a 1-year view that coal price can shoot up to, I don't know, 200 and 200 something. So that's why it's very challenging for us to initiate coal price. You have to either start it when it's just about to turn and start it at the low and then ask people to be patient for the next 1 year. So that's why coal price, writing on commodity stocks is very challenging. Our timing has to be almost perfect, and we need to take a 2-year view. The only one that maybe looks a bit more flattish is maybe like rubber prices. So that could be I guess a bit more interesting because the prices have not like hit the 10-year highs like all the other commodity stocks. The next one is who's the largest glove manufacturer in PRC? The two names is Inco, INTCO, and Blue Sail. I'm not sure why they call it Blue Sail, but it's listed in China. So these are the two largest ones that's mentioned a lot. You can even see it in the press, especially the Malaysian press that takes out. A very informative regarding the construction industry. Is that why Yongnam is lagging? We're not familiar. I know Yongnam is still struggling for MRT and so forth, but it will affect everyone. The only ones, if you notice, we cover is Pan United and BRC because the raw materials is fine. Raw materials they don't have to hire that many workers, and they won't be hit by all these additional costs. But of course, the only thing you have to worry is just the trade debtors part because their customers are the construction companies. I'm not sure about Yongnam, but anyone in the construction industry, I think in general, I mean, without naming anyone, I think in general it will be very, very challenging. The cost just surge on 30%, you cannot pass it on. Okay, largest in manufacturing capacity. I'm not sure the capacity. I need to double check on the Chinese ones. I'm not sure. Yeah. Okay, the other one is on the construction challenges. More generally, what's the impact of the increased cost on the property companies like City Development, Singland, UOL? Okay, I'm not sure if Matthew has anything to add, but of course, costs, there are two parts to it. The cost is kind of fixed already. So actually, construction companies take most of the pain. Maybe in the new projects, you take the higher cost. That's number one. Number two, the developers benefit in a way because of all these delays. I think 6 to 9 months is the rough delay period. I think that's what Oakley said. When there's delays, it actually causes the HDB upgrading market to kind of pick up. And I guess there's everyone is rushing now because the prices continue to rise. And also because when construction costs delay, costs increase, it actually helps property price because everyone kind of knows that the property price has to increase because there's a huge replacement cost now because the cost across everything is higher, even for the HDB. Yeah, so I think in a way they may have higher costs for newer projects, but they benefit from the whole upswing in property price. Yeah, I hope that answers it. Okay, Terence, you have anything? I'm just looking at the rest.
Yeah, okay. I'll swing in to answer some questions, then maybe the rest of my colleagues can chime in also if they have something to add. The first question is, will DBS benefit from MAS blacklisting Binance.com? So I think your question is related to whether this will lead to, because MAS blacklist Binance.com, so whether this will lead to more crypto flow into DBS, we think that it's a little bit limited in terms of the impact now. Firstly, DBS is very cautious in terms of account openings for accredited investors. So only accredited investors can buy cryptocurrency assets on their platform now. So they're very careful also in terms of who can open, even though you're an accredited investor, but if your risk profile don't fit the criteria to buy crypto, then DBS will also not onboard you onto their platform. So, and the in terms of trade flows with regards to cryptocurrency, I think DBS, they don't review how big this is, but we understand this to be very small at this moment, at least at this moment. So not a very big benefit in terms of the blacklisting. I'll go on. Sembcorp Industries, hold or sell. In our last report on Sembcorp Industries, we maintain our neutral rating on Sembcorp, mainly because the target price of Sembcorp Industries is based on 1 times price to book for financial year 21. So that translates to about $2.01. So at these levels, it's a hold for us. And then when we look at the outlook for Sembcorp Industries, it also remains a little bit more challenging because for second half of 2021, they have some downtime in terms of maintenance. So we expect the results to be slightly weaker on a half-on-half basis for Sembcorp Industries. So right now, because of the more challenging outlook for the group, our call on the group is still a new whole or neutral in this sense. The next question, the opinion on the 3 banks is overweight. How will the arrival of the digital banks affect this? The issuance of the digital banking license is not new. They already issued wholesale banking license, digital full banking license to some of the players like Grab, Singtel as well. But we don't see the impact of the digital banks being very material for the 3 local banks. One of the reasons why is because the 3 local banks have already invested over the last few years. They've already invested a lot of money into the digital space. So on that front, they are really very well equipped and they are very advanced also in that front. And in Singapore, where they mostly operate in, the banking penetration rate is nearly 100% already. So we see even if they come in, the market share that they can get, or the kind of business that they can get, we see being very limited. So we don't see a very big impact on the 3 local banks. But where we think the digital banks can probably add value is probably in the region where the banking penetration rate is a lot lower compared to Singapore. Yeah, let's go on and let's see whether it's okay. There's one question here. Hi, Terence. Regarding the SGX institutional and retail fund flow weekly tracker, you can get it from this website. Yeah, thank you. I believe last week some of your clients asked you about this matter. The SGX homepage will provide the latest update around 11:36 every Monday. Hope this helps. Oh yeah, thanks. So I think Gordon has provided this SGX institutional and retail fund flow weekly tracker. Yeah, I think but if I recall correctly, correct me if I'm wrong, but I recall correctly, one of the question last week was the daily institutional and retail fund flow. But so this one that you provide is the weekly one. But I think the question was daily, and so we answered that already. But anyway, this is helpful. So thanks so much. Yeah, I think that's all the questions from me. Yeah, thanks.
Yeah. Oh, okay. Let me try and.
Sorry, Paul. I think there's one question on SGX I missed out. Sorry. Maybe. Yeah.
Please go ahead.
Maybe, yeah. Thanks. Maybe I comment briefly. Because I see some questions on SGX also. But for SGX, our last rating on the counter is also neutral. The reason why is because the outlook for 2022 is a little bit more challenging. And the last time we downgraded to the share price also for SGX is because their operating expenses is also expected to be a bit higher than what they previously guided. Of course, what they say is they're going to invest in this growth, medium-term growth So the OPEX and CAPEX also expected to be a little bit higher than what the street was expecting. So that's one. The second challenge facing SGX also obviously is the launch of the MSCI the MSCI China A50 futures that people expect to affect the FTSE. But that kind of challenges, we see some near-term impact, but we don't expect the impact to be too material, mainly because it usually takes about 3 to 5 years for them to reach the kind of maturity. It's not like immediately you launch the futures, you see trade flow, because you need liquidity to come in as well, to set in as well. So the impact is while negative, is not going to flow in. Nonetheless, our rating on SGX is neutral at this moment. Yeah, sorry, Paul, you carry on. Thanks.
Oh, no problem. I'm just trying to wrap it up by 12:45. We see a lot of questions on some of the Chinese companies. Sorry, we don't cover. Better to get it from our Hong Kong office, because if we tell you, it's all going to be wrong anyway. Yeah. Next one is what is your view on the incoming SPAC listing on SGX? There will be a lot of education webinars done by us, because I think this is part of the SGX scheme to educate investors. So when that happens, we will let you know. But just remember that SPAC is nothing more than just another structure, another vehicle or corporate structure to do IPOs, and so it's still back to the assets that they are going to be buying. The reason why the US ones do well is there's a bit of arbitrage, so a lot of hedge funds subscribe from my understanding from the US specs is because you get it at $10 at cash and you get free warrants, so it's almost like a riskless kind of arbitrage for the spec. But don't get enamored by specs. I mean, in the end, it's just a basic structure vehicle to buy, to go through, and I don't know why not IPO, right? So it's just another structure. So just be wary of that, and not because it's a spec there should be a premium attached to it, despite who the personality is. Yeah. Okay. Jaffa, I'm not sure. I think we kind of talked about it. Yeah. Sorry. Paul, why are UOL and CDR not responding to robust property sales in Singapore? I'm not sure if Natalie, if you want anything to add, but my take is for property developers, if you look at some of the delistings, even Perennial, the one that's owned by Kokun On, the Wilma owner, they even privatize it at correct me if I'm wrong, but it's roughly 0.6 times book. And people and investors are also happy to let it go. So there's a bit of derating of all the property developers. Actually, they're not so much of the other, but any property companies. Yeah. And that's because even though margins are thin, number one, and you worry that when the cycle goes up, you worry the authorities clamp down on it. Yeah. So there's this big I wouldn't say issue, but there's this overhang on developers. So bad until, as you all know, I mean, Capital Land decided to even just get rid of the property development. Yeah, because I think investors just don't want to pay much premium or value to developers. Yeah, and not to mention there's also a lot of competition from the Chinese developers. Yeah, that's my general sense. Yeah. And Natalie, you got anything to add?
Hi. Okay, so I'll just add on. Yeah, for some of the property developers, especially those that have a relatively significant portfolio that is exposed to the hotel industry or the hospitality kind of assets, you can expect that of course there will be some cautiousness with regard to the longer timeline for recovery. Of course, I think Singapore, we are currently leading the way in terms of vaccination rates. So Singapore will definitely be one of the countries that will be first on the list when it comes to the negotiating of travel lanes, travel bubbles. But I think for some of the property developers, UOL included, as well as CDL, they have a relatively substantial exposure to the hostel or hospitality industry. And in terms of property development, while yes, it's true that the prices have been increasing, be it new launches or even the resale market, the prices have been relatively buoyant. I think the people who will be laughing to the bank, so to speak, I think will be the property agencies, because these are the people that they will still take a percentage cut of the total price, whereas the property developers, they are faced with, of course, in this slightly hampered COVID-19 construction situation, they are facing a little bit of a margin compression over there, and also of course the main contractors, because even though the impact of this price increase in terms of construction, it really depends on where these properties or these projects are in terms of their development timeline. So those projects which are nearing completion, nearing their TOP, of course, that means most of the construction cost has already been incurred and already been injected into the building. Those projects that are at the later end of their timeline, they will face less price or rather cost increase. Those projects that are new, starting out or in the middle of their portfolio of their development, they might be the ones that will have to sort of share in the cost with their main contractor. Yeah. So overall, if you look forward, I think that there will be a little bit of margin compression. However, of course, the rising share average selling prices does help. And overall, as most of these property developers or property companies, they do have exposure to other kinds of, like I mentioned, hotel operations, but some of them also own investment properties, which, as you know, if it's commercial, there's still a little bit of headwinds. Retail, although it's recovering well, I think there's also a little bit of tenant caution. So overall, the picture is it might still be in the near term weighed down by all these other factors. So I hope that helps.
Yeah, okay. Let's just try to clear. There's one on SPH REIT to hold. So we don't cover SPH REIT, but no, SPH REIT is mainly, I think we all know, is Paragon, is in Orchard. I guess if you really want to play the most beta on reopening, it probably might be Suntec. Yeah, because if there is a reopening of our borders, the Suntec can be the big beneficiary, because it's all the MICE convention. Yeah, and also the Atrium, because Atrium is a huge high margin, because the space is already there. So if you really want to play into, because SPH, if you buy SPH, means you're buying into tourists coming back, reopening. Then if you're going to take it, you must take it to the extreme, and just get into Suntec, because that would be the MICE crowd. Coming back. I'm sorry, the MICE means convention coming back, business conventions and group meetings. That would be at the very extreme part of it. Yeah, I hope that helps you. In terms of Franken, UMS, Sarin, Wholesale, we don't cover any of this regretfully, but of course we do attend a lot of the UMS meetings. The UMS looks the strongest because it will be on, I'm not sure about Franken. Sarin is, I think, diamond machine. For UMS is because they are front end machine. So as you saw the news, SMIC also building more wafer fabs. So all this will benefit indirectly UMS because of their link to applied materials. So for me, like in my own view, is that UMS is clearer. You don't have to worry about the component shortages and so forth, because they are building into the equipment which is for the wafer fabs, not into the end user, the like phones and so forth directly, I guess. Okay. I think we've answered most of it. Natalie, you want to answer anything on Tasin retail?
Okay. Yeah, I'll take that question. On Tasin, I think in terms of operation wise, the China market is gradually improving. I think so far what we know is that despite some of the spike in cases in August, there have been no more closures, or maybe even there has been no reported mall closures. And I was speaking to the management of Tasin. On their end, they also really haven't heard of it. They said that they did mention that if there were to be like a minor, maybe 1 to 3 day kind of disruptions, it probably might not have been announced or reported because it might not be so significant. But in terms of the larger kind of mall closures, if you're going to talk about like 1 month or significant reduction in their operating hours, then probably there will be some reports of it. But so far there has been none. Okay, in terms of Dasin, with respect specifically to Dasin, the share price is still under pressure, I think because of the lack of refinancing clarity. So of course, the hope is that with their new shareholder, or rather, sorry, sponsor coming in, that could help with the refinancing, because the new sponsor that's coming in is actually quite very strong, and it is for about 40-45% of the new shareholder, which is Sino-Ocean, is actually owned by 2 China insurance companies. So hopefully that will help with the refinancing as well as the refinancing terms moving forward. So the critical date to look at is of course December 19, if I'm not wrong. So that is when the refinancing has to be completed by. Yeah. So in the near term, this does weigh down on Dasin's share price, and I guess that is also a large portion of the uncertainty. Yeah. Okay. There's also a question on Elite Commercial REIT. So for Elite Commercial REIT, we do not cover, but I'll just provide a little bit of insight. For those who are not familiar with Elite Commercial, their portfolio of assets are largely leased to the Department of DMD. I think it's the workforce department for the UK, which means that the assets are actually used as, for example, job centers, or where they process these unemployment claims. So of course, during COVID, they have been very busy. In fact, the government has opened 150 temporary new job centers, to help retrain, reskill their population and help them hopefully be able to become fully employed. Okay, so how this affects Elite is that in some of the locations where they are at, in the not so near vicinity, there have been some job centers that are opened. Yeah, and also of course, while the number of unemployment claims and the foot traffic in terms of these coaching for new jobs, that has increased. There's also a risk that maybe the government may not actually renew the leases, and of course evaluate some of the other temporary new job center locations. So just to provide a little bit more color, these 150 temporary new job centers, the leases are usually like 5 years with a lease break in the 3rd year. Okay. And in terms of their portfolio, one of their assets actually had the government did not the lease break was actually exercised. Yeah, and this is actually a bit curious because this particular job center is actually located in Aspen, where there have been new job centers that popped up, to cope with the increased volume of people coming to the job centers. Yeah, so in terms of Elite, all things considered, we don't cover it, but my general feel of it is that Elite is is supposed to be relatively stable, kind of a REIT. Yeah, so that is of course positive. Yeah, of course the share price has not yet recovered to the pre-COVID price, although the timing of this introduction of Elite is a bit it was very near. It was February 2020, so it's very, very soon before the pandemic. But yeah, I think overall, if you I would classify Elite as one of the stable plays. I think that's all for me. I'll hand the time back to Paul to wrap things up.
Okay, thanks everyone. We still see some questions. So sorry, because in view of time, I think Varian has a 1 p.m. event, so webinar. So sorry, we can't answer some of these. But you just send us an email or in our Stocks BNB community page. So thanks everyone. Hope you have a good week ahead, and thanks for listening in. And do feel free to attend any of our webinars on the Poems event page. So thank you everybody, and hope stay safe and take care everyone.